here has worked with a bank statement program? Ever? Anyone? A bank statement program? Okay, so for the next few weeks, we're gonna do a deeper dive into some of these niche programs. I mean, by now we're in 2025. They are as synonymous now with a conventional loan. Okay, so as a loan officer out in the front in sales, this has to be a part of your tool bag. Okay, not just FHA and some type of conventional Fannie Mae, Freddie Mac product. Non-QM loans, again, we started off earlier in the year introducing a whole slew of non-QM products. I know we just kind of touched over it. We're going to do a slightly deeper dive. That doesn't mean this is going to be a long training. There's not much to it. When it comes to the bank statement program, before I share screens and do all that pricing and all that, the main difference really, the only difference really is how do we qualify that income, right? Because we still, under the Dodd-Frank, the federal rule, Dodd-Frank, and qualified mortgage, we still have to meet the ability to repay the ATR rule, right? You guys are all familiar with ATR, right? ATR is what drives mortgage in America, okay? And that's why we have ATR now. That's why we have Fannie and Freddie and FHA and everyone else has now implemented these DTI rules, the debt to income ratio rules, so on and so forth. Okay, so now obviously with conventional loans, they're using tax returns, W-2s, pay stubs, right, to calculate an income, ultimately qualify that income against your debt, and that's how you meet ATR, the ability to repay. The same rule applies in the conventional, the non-QM world, because these are all TRID loans. So, but in lieu of looking at tax returns and pay stubs and W-2s and running a 45060, excuse me, and meeting my kids are on break now, and meeting right, the debt to income ratio, we're going to use, instead of that, we're going to use bank statements. Now, there are other methods. We're going to dive in a little bit deeper in the following weeks. But bank statements is one of the most, it's actually one of the very first non-QM products that got rolled out back 2014 and slightly before that. And in short, all it is here's a business owner. Obviously, you have to be a business owner or self-employed. And we are going to today focus on business bank statements. Instead of looking at their S corporation, their partnership, and looking at the bottom line, usually line 21, I believe it is, and looking at their net income and adding back, we're going to, because a lot of self-employed borrowers like, right, not paying taxes. They don't like paying taxes to Uncle Sam. So they're gonna, no matter what that income, their gross income is, right? Whether they underreport it or report exactly on the top line of their business, their whole objective is to minimize their net income, right? You minimize your net income, then you minimize your tax liability to Uncle Sam. Well, when you do that, you can't qualify, or that prevents you from qualifying for the larger loan amounts, right? And then obviously in today's day and age, that's not going to help. So instead of looking at tax returns, we'll look at this with bank statements. So imagine your borrower is self-employed, you request for 12 months bank statements, and these bank statements show, I don't know, $50, $100, $200,000, $700,000 of deposits in their monthly bank statements. Okay. Well, how it works then is they average the bank statements, or the average the deposits every month. Okay. You assign it an expense ratio, and usually in with all lenders, some of them are 40, but most of them are 50%. Okay, expense ratio, right? So if it's $100,000 average deposits every month over 12 months, you give it 50% expense ratio, you're left with $50,000. That becomes essentially, that becomes your qualified income. Does that make sense, guys? Okay. All right. So if that makes sense, we're going to kind of dive into now, because here at Giving Tree, we have so many different lenders that we work with, right? Some are brokered, some are non-del. We're going to look at a few lenders today because your scenario may not fit. Maybe you get the income that you need, but maybe you don't have the FICO score that's needed. Maybe you don't have enough reserves that's required. So we just want you to be aware, okay, that though you're going to be going with the bank statement program, you as the loan officer, still has to do your due diligence in seeing which lender you need to work with. Okay, so I do apologize in advance because I'm still kind of learning how to create presentations through Gamma and using AI. I'm gonna admit it is not the best presentation, and I wasn't super lazy. I did kind of change it around a little bit or edit it, but here we go. So okay, so we're going to look at different bank statements, okay? And this is actually a presentation I did for a realtor. So I'm going to just kind of skim over some of these slides, okay? As it's not super important, but I want to get into the meat of it. Just know that 30-year fixed rate or 30-year amortization and fixed rates are not offered by everyone, okay? There are other options. You can get ARM options. You can get 15-year options, okay? Generally speaking, most lenders only offer a 30-year fixed rate, okay? And you'll kind of understand as you get used to it and you price it out and you look at their matrix, you'll see it's going to be those who are very conservative, and then you're going to see those who are more flexible, okay? Right off the top of the bat, Rocket is a very conservative, though they are non-del, and though we can work off the rebate, and though they tend to have very attractive rates, Rocket is very, very conservative, okay? One of the things that they only offer a 30-year fixed rate on their bank statement program. No ARMs, no 15-year, okay? Another thing we'll see later down in the slides is with Rocket, their maximum or their minimum expense ratio is 20%. You cannot get lower than 20%. I have a deal that's 10% right now, and I was just curious. So I actually called Rocket, Jeff, and he said, sorry, we don't go to 15 or 10. Okay, others do. But you'll realize that some, other lenders are more, they offer different product terms than others. And so that's why it's really important for you guys to kind of look into who you want to go with. This slide is kind of horrible, but gift funds. Not all lenders allow gift funds. And if they do, there is minimum contribution. So for like AmWest, gift funds are allowed on primary and second, but you cannot gift funds are not allowed on investment properties. And I do apologize. Let me back up and say, just for this presentation, we are going to be looking at 4 different lenders: AmWest, Rocket, Mega, and NewFi. Okay. Sorry, I don't know why Rocket came up like that, but Rocket does not allow gift funds. Okay. Rocket does not allow gift funds. For Mega Capital, as long as borrower does minimum 5% contribution, or 5% minimum borrower contribution is needed if you're doing less than 25% down payment, okay? And I was really surprised by this. Mega Capital does allow gift funds on those that are investment properties, but minimum contribution by the borrower is 10%. That's a very big a difference with Mega. Mega tends to be very accommodating in their matrix. Okay, so where AmWest does not allow any gift funds for their investment properties, Mega does allow it, and but there is a 10% minimum contribution. Okay, and the same goes with NewFi. You will learn that NewFi is actually pretty aggressive in their matrix as well, just like Mega. So usually for myself, all my non-QMs, I've either gotten with NewFi or Mega. I like going with Mega better because we can get rebates. NewFi, if you're brokered, unfortunately. However, NewFi, generally speaking, has the better rate because they have two different programs. One's called the Sequoia and one's called the Rainier. The Rainier has really good pricing. Usually, it's not always the case. Make sure you go into Loan Sifter and price it out. Okay. I'm going to skip through the income documentation. I'm just going to go to the matrix, and for sake of time too. So here's a chart I want you guys to look at, and this is why we wanted to do a deeper dive, because lenders do have offered different thresholds when it comes to their ratio, the DTI, their FICO, and especially the reserves. Okay, I'm going to break down reserves later because that's always a big one. So notice that here at AmWest, you can go as low as 620. Okay, NewFi, however, on their Rainier product, which is their preferred priced loan for bank statements, you have to have a 700. That's a huge distinction. 700, right? And 620. Now notice though, NewFi caps it out at 45% DTI. Okay, whereas AmWest, again, they're very aggressive. You can go up to 620 FICO score with a 50% DTI ratio. Okay, but where it does change a little bit is your reserves. Okay, though AmWest does allow you to go to 620 and a 50%, you'll notice on the next screen that their reserve requirements are, a little bit higher than, say, NewFi's. Okay, do you guys see that difference? NewFi, right off the bat, if it's under 750, only requires 3 months. AmWest is going to require 6 months. Okay, even at the higher loan amounts, okay, like 1.5 or lower, NewFi only requires 6 months, whereas AmWest is going to require 9 months. Any questions? Okay. Another one that I didn't include, but it came up after the fact, is NMSI. Okay, NMSI, and I'll bring it up real quick because I want to show you it. NMSI is actually also very aggressive in their matrix. Okay, however, so this is their guideline, and I'm going to show you how to get to all this. Look at their reserve requirement. Okay, if they're doing 25% or less down payment, you only need 4 months. If you're doing more than 25% down payment, no reserves are required. Really, really aggressive there. Okay, so when